Could we just zoom in on that point about you want to lend at high rates freely, lend freely at high rates against good collateral? What does that mean when the Federal Reserve lends? So the Federal Reserve raising rates through the Fed funds rate, that's not collateralized, right? And then QE is just, your QT is just buying or selling. It's not lending. So Joseph, I want to bring you in. In what way does the Federal Reserve lend against collateral? I guess that's repo, reverse repo. And then in what way is the collateral shaky? Because it's not as if the Federal Reserve is lending against, CLOs or anything.
Yeah, so that idea, Bejo's idea, goes back to the central bank as a lender of last resort. And that's really what the Fed was originally all about. So before the Fed's foundings, the banking system often will get into these panics. So people would come and ask the bank for money, and the bank would run out of money, and everyone would panic, and the bank would fail. So they came up with the idea of a Federal Reserve as being able to lend to the bank in case they, had these liquidity problems. And that's called the discount window. And so what would happen is if you are a bank and you were having liquidity problems, you could call up the Fed and go to the discount window, and you'd have a folder full of loans that you have on your balance sheet, and you would ask for a loan against this collateral. The collateral is now going to be risk-free. In fact, the discount window accepts a very wide range of collateral, basically anything, and the Fed will look it over and lend it at a discount. So let's say you have $100 worth of a corporate loan. Maybe the Fed would give you 90 cents on that, and so it'll be at a rate that's slightly above Fed funds. So that's really how it works. In practice, it's not as often used anymore. The reason is because like the Fed has flooded the system with so much liquidity that the banks almost never have any liquidity problems. So I guess this is another way to think about Michael's quantity issue, right? It really does solve a lot of the problems that the banking system used to have. I would also take it into another way. So just as Michael noted, in the capital markets, it's often a refinancing mechanism. The new issue, the net issuance that grows every day is not that much. But what most of it is just the same companies, the same people just rolling over their current debt. Now, if you've been following us for a while, then you know that at a high level, money can come from a commercial bank or it can come from the government, right? So when you're refinancing something, you need someone to have money to lend it to. You need basically like a bank deposit. And you can have that coming out of a bank, so a bank can actually make the loan. Or if the money has already been created by the Fed, then someone else reallocates that bank deposit that's already been created. So basically through a capital markets transaction, like if you're a hedge fund or something like that, taking your money and lending it to a corporation. That's another way that this liquidity can move. And if you're doing QT, you're kind of shrinking away that second part of the money supply. So that, again, it's a tightening condition. So where quantities come into play, and it's not just about price, as Michael noted.
I think, there's a way to see this is to look at data. And there's some charts you can take a look at, Jack, that I think I winged over. But one of those, which I think is around slide 8, is looking at global liquidity, and it looks at the growth in global liquidity, and it compares that to the growth in asset markets worldwide. And you can see the correlation is eye-wateringly close. So what this is saying is all asset markets, whether it be equities, whether it's fixed income, whether it's real estate, whether it's crypto, are all driven by this concept of liquidity. The amount of money in financial markets clearly governs what you can buy, and that gives you a pretty decent heads up. What's the interesting point is that correlation has actually tightened over the course of the last decade. So it was about correlation coefficient of about 0.6. Now it's over 0.8. So what you've got is a tightening of correlations. Now, the other way to look at this, and I know this is a concept that Joseph's also has got strong opinions about in terms of the future Fed balance sheet, is if you look at a following slide, I think it's maybe a slide 15. And what this is looking at is net liquidity injections by the Federal Reserve into U.S. money markets. Now, the point that we make here is that the Fed balance sheet per se, the reported Fed balance sheet, is not really what you want to be looking at. It's important, but you want to be thinking about the effective balance sheet. In other words, how much liquidity the Federal Reserve puts into U.S. money markets. And that's what the red line is basically indicating. These are the sizes or the size of those liquidity injections. Now you'll see on that same chart, we've put the S&P 500. And what you can see is the tracking between the two is pretty close, particularly recently. The gyrations in Fed liquidity injections have pretty much led to similar gyrations in the market. Now, the point that we've got to make here and we've got to stress is that if the Federal Reserve is realistic about what it intends to do with the balance sheet, and take a look at the estimates that the New York Fed have, or projections the New York Fed has put in for the next few years, which is came out of its document on open market operations for 2021. They included in that projections. What you're looking at is a sizable drop in something called SOMA, which, as Joseph will clarify, is the system open market account. Now, that's the amount of treasuries that the Federal Reserve holds. Now, as an interesting aside, those of you who are sci-fi fans will know that SOMA was the drug that was in Brave New World, the book by Aldous Huxley, and it was the feel-good drug that everybody basically had. Well, SOMA in the Fed context is the feel-good drug, the monetary drug. And somebody at the Federal Reserve at some stage, when they named SOMA, must have had a great sense of humor, because it basically is there. Now, the SOMA account is dropping from, slated to drop from over 8 trillion to basically under 6 trillion over the next 3 or 4 years. Okay, that's a big, big drop. But then you've also got to take into account what's happening to the Treasury General account and also reverse repos. I know Joseph has opined on this as well, but our view is that you've got potentially on top of the drop in treasuries, you've also got reverse repos which could move up simply because if rates start to rise, which they clearly are in the US, money market rates will rise at a faster rate than bank deposit rates. So you're going to get a lot of demand for reverse repos from the Fed, from the money funds. Do you think that's right, Joseph?
I think that's absolutely right. I think there's a risk that the RRP can actually go to 3 trillion by the end of the year. There's a lot of things happening in that space. I mean, one, it's that there's just not a lot of money market investments yielding above the RRP. So a lot of money funds are just piling into the RRP right now as we speak. And the other is, as you noted, there's going to be people moving out of their checking account, which is going to give them 0, to a money fund account, especially if the Fed hikes, let's say, 3% by the end of the year. So that's going to suck a lot of liquidity into the RRP. It could be a very big number.
Yeah, and if you're a monetarist and you look at M2, what could easily happen here is that actually M2 contracts in absolute terms, because you're going to get disintermediation out of the banking system into money funds. I mean, that's not impossible. So I think that one's got to be cognizant of some of these risks. And the banks will be, if the banks are lending at the pace they're currently lending, and inflation is clearly encouraging them to, or encouraging demand for loans, where are they going to get their funding from? So you've got potentially, this is the building up to what could be potentially a Federal Reserve mistake. Now, if you go back to the previous slide, Jack, which was looking at that chart of the S&P with Fed liquidity injections, and you just do simple eyeballing of what's going on in that data, what it basically says is that if the Federal Reserve is correct in its intention to take 2 trillion out of the balance sheet, let's say that on my right-hand axis, you get 2 trillion out of net liquidity injections, and you eyeball what the S&P would be, the answer is about 3,200, right? If you take Joseph's projection and you say, well, we're going to lose another 800 billion to a trillion of extra money sucked out because of reverse repos, you're talking about 2,500 on the S&P. Now, these are eye-watering numbers. We've got to be, these are the risks in equities. And I don't think the market's fully got there yet. And what's more, we've said nothing at the moment about the real economy.
Just as a question, so Michael, in your indicators, have we ever seen a tightening this rapid, or at least like the velocity and the level? I mean, is this something that has happened before? Like the level, both the speed at which it changed and the level we've fallen to.
This is pretty rapid. I mean, if you look at the impact that you're getting just to take U.S. bank reserves as an example, this tightening is. I mean, we've lost $1 trillion out of bank reserves, as you know, since the end of last year. Which, against the background where the Federal Reserve supposedly is not doing QT yet, is remarkable. But what that tells us is they are doing QT, but it's a secret one. It's beneath the surface.
And sorry, Michael, that beneath the surface QT is reverse repo.
Yeah, because that reverse repo is going on, or the Treasury General account is moving. But effectively, it's other factors. It's not the SOMA account. The SOMA account is, it's drifting lower, but it's certainly not plunging to the extent of by $1 trillion. So what you've got is a tightening, which on paper is about 5 times faster than we've seen before. Now that may be overly dramatic. But there's a chart, I think, that in the pack, about slide 15, which looks at the immediate or the previous tightening, or a previous tightening, yes, in the Y2K period. Now, what that shows is that actually we're tracking pretty similar to that one. The gradient recently has been maybe sharper. So you look at this chart, and basically what that shows is the yellow line is the current cycle, and you can add a little bit to that where current data is basically around 40, so it's got a little bit lower to drop. On the chart, this chart's a little month out of date, but we're getting there. And if you look at that timeline is basically shown in the Y2K crisis. Now, where you've got signaled there 2001, what that basically says is think of that as the turn of 2023. So what you could easily be seeing there is a very sharp rebound in the yellow line when it gets there. But traveling is worse than arriving in many cases, and so you're going to have 6 months of pain while that yellow line goes down, and then there's maybe a sharp rebound. Now, one of the things that you will see if you look at a track of the S&P is that the S&P goes up not as the Federal Reserve is turning, as the supertanker changes. It's when it starts to speed up. In other words, when you get that sharp uplift in the yellow or the red line on the chart, that's when you tend to get some of the biggest moves in the market. So in other words, we may be thinking about Q2 of 2023 before there's a meaningful jump in the markets. Now, where to position prior to that? I think you've got to go in the front end of the Treasury curve and maybe start to put a toe in the water at the back end. Now, that judgment really depends on where inflation settles and what the underlying level of inflation is, and maybe some of the global backdrop. I mean, what happens in Europe, for example, maybe even what happens in Japan, because I think there's 2 other ugly scenarios that we can go into that sort of also will affect US markets or global markets.
Could we just zoom out a little bit, Joseph? Could you speak to the Federal Reserve's appetite to moderate inflation, get back to its 2% inflation goal or close to that? And what is it willing to sacrifice in order to get there? Historically, a shoot up in high yield credit spreads or a freezing of the credit spreads or a sharp 20% decrease in the S&P 500 was enough for a Fed pivot. But is the bar for a pivot much higher now, given that inflation is so high?
I think the Federal Reserve is very serious about inflation. When you had Biden invite Chair Powell to the White House, sit him down and talk to inflation. So, I think he has the political cover to do whatever it takes, and that includes crashing the stock market. So I imagine that's what they'll do. The Fed cares about the mechanics of the financial system, so they want the markets to function. That means, so let's say, orderly buying and selling, or do you want to make sure the corporations can be able to refinance their debt, right? That's how the financial system impacts the real economy. Corporation needs to borrow money on a short-term basis to make payroll and things like that. So as long as those things function, that's fine. Equities, it really kind of doesn't really matter too much into the mechanics of the real economy. in the sense that it does go down a lot, it actually helps the Fed because, you tamp down on animal spirits, maybe people buy less stuff, maybe that'll help in inflation a little bit, basically decreasing demand. So I suspect that Chair Powell has enormous resolve, and he's going to slowly massage the market towards a higher rate path.
That word slower is something I'd love to zoom in on, because I recently was speaking to an expert in volatility, and I asked, why is the VIX only at 23, 24 if we've had these vicious sell-offs? And the matter of the fact is, on an index S&P 500 level, they have been vicious only on the 1 month, 2 month scale, but not on the 1 day scale. So you haven't had that huge spike in daily realized volatility. Of course, Carvana and Netflix, not Nirvana, Carvana, Netflix, Snowflake, all sorts of these stocks have really had a very tough time. But on the equity level, S&P 500, you haven't had a huge spike in realized volatility. And as a result, the VIX hasn't spiked as well. My question for both of you is, do you think that this sort of orderly annihilation of the markets, where the S&P 500 goes down maybe 1% a week, is preferable to a dramatic sell-off that really could start a market panic? Because, Michael, I know you've done a lot of correlations to how when liquidity recedes, the VIX spikes. But do you think there's a scenario in which we could have a huge sell-off over the course of a year, but the VIX doesn't spike because it's a pretty sort of an orderly sell-off? So Joseph, how about we start with you? Do you think the Fed prefers what we have now, where it's a very gentle sell-off, as opposed to a true panic?
No, you're absolutely right, Jack. As you suggested, I think this is much smoother for everyone, actually. Just have a orderly demolition of risk assets. It's bad if you own puts, but for everyone else, I think it's much preferable, because when you have these big volatile moves, something somewhere could break. And so you don't really know where. It's a really complicated system. Eventually someone, for example, could get wiped out, get margin calls, forcing other people to get margin calls. So having this slow motion thing, I think allows the Fed to be more comfortable having asset levels go lower. So for example, if we were to go to 3,000, it'd be much better if we did that over a few months than if we did that over 2 days, right? If we did that over 2 days, then we'd have QE the next day. but the way that we're doing this, we could do it. We could, I guess, more effectively accomplish the Fed's task of tightening financial conditions.
Yeah, I think that makes absolute sense. I mean, if you look at what drives the VIX, in our estimation, it's really driven by two sets of factors. One is volatility in other markets. I mean, way back when I was at Salomon Brothers, we did a lot of work on the sequencing of volatility. And what you found was that volatility tended to begin in the fixed income or the Forex markets, and then it migrated into the equity markets. So it was a little bit like squeezing a balloon, and it would bulge somewhere else. So what you would get is that transmission. So I think that's one thing to think about. And you've started to see that sequencing. You've got high volatility in the MOVE index in fixed income. You're starting to get more vol in the currency markets. And then ultimately it's going to start to come out in the equity market. But the real trigger for VIX equity market vol is a recession. And that's, I think, the thing we need to focus on. Is a recession coming? Now, if you look at a lot of the leading indicator data that we look at, I mean, we're absolutely convinced it's coming. If you look at, if you take a global view, our numbers tell us that Asia is already in recession, courtesy of maybe to a large extent China here, but it's in recession. Europe is just entering recession, and the US is probably a month or two behind that. So the US is coming. But, look at some of the recent earnings numbers or earnings reports coming out of Walmart or Target. I mean, they're showing whopping great increases in inventory, 30 to 40% jumps. I mean, this is not a happy situation. And so it's bound to be translating into a slower economy. And a lot of the leading indicators, even looking at the Michigan Consumer Survey, I mean, these are really, really ugly numbers. So I'd be really concerned about a recession upcoming. The Fed's focus is very much now on getting inflation down. And the issue is not so much the wrong question, I think, is to say whether inflation is peaking, and who knows on the Friday print, are we going to see a peak or not? And I think that's a sort of flip of a coin. There are arguments for and against. But the main point is, what's the persistence of inflation? And we do calculations which look at the spillover from month to month of the inflation numbers for the US. And you're looking at persistence levels which are sort of up at the late 1970s rate. So what does that mean? It basically means that for every 1% change in monthly US inflation, you get a spillover currently of about 0.8% the next month, and then 0.6% the month afterwards. So it's a huge amount of persistence. The last time you saw that degree of persistence, you basically saw Volcker in the Fed. Now, what was the result of Volcker? Well, we know that sky high interest rates and 2 recessions in 3 years. Now, is Jay Powell a Volcker? I don't think so, but I think that he's, treading that path. So I think they're gonna focus on getting inflation down and concentrating now on tightening over the next 6 months pretty aggressively.